Do you guys want to go now? Can everyone please quiet down? Okay, good luck.
Thank you.
Welcome everyone. Today we'll be talking about the proposed acquisition of Rite. Our speech will be basically structured in the following way. First we'll talk about the acquirer, Amazon, which is, as you know, it's a dominant online retailer and IaaS provider. Then we'll talk about the industry of Amazon, which is actually quite unique. Then we'll go on to talk about the targets, and namely our target is Rite, which is in integrated pharmacy, and PBM, as the team presented before mentioned, PBM stands for Pharmacy Benefit Managers, and later on that topic. Then we'll go on to talk about the rationale of the deal and why it makes sense. Then we'll talk about the valuation, which has an implied EV of 7.7 billion, which includes a 105.7% premium to the current trading price. And then lastly, we'll talk about the deal transaction financing, which in our case is going to be a 100% cash transaction.
So our execution team consists of 5 final year Warwick students, 3 of which are presenting to you today. That is myself, Nikita Mazaev, and Jeremy Montaro.
We will begin with presenting our acquirer or our client, Amazon.com. As we are all aware, Amazon at 23 years old has been growing to become America's giant. What I mean by giant is that it is a giant of 2 worlds. 1, online commerce, and 2, internet provider as an infrastructure as a service or IaaS cloud service. Amazon itself has been growing for a very long time, and on the online retail side, Amazon has a 30% market share. This market share that we calculated using the gross merchandise value method ensures that we take into account both online platforms like Amazon and eBay, as well as other competitors. Amazon itself has always been interested in growing through different expansions and different acquisitions. If we look at the key dates, we can see that Amazon started in 1994, Amazon.com as we know. The most interesting offering of Amazon is actually Amazon Prime. Amazon Prime is a company's primary retail subscription service. Amazon Prime offers 1 day or even 1 hour delivery service in 33 US cities. Spans from all the way in Seattle, the hometown of Amazon, all the way to New York. Apart from that, this segment has been the biggest segment or revenue driver for Amazon. Next up is Amazon as an IaaS or cloud provider. On the cloud provider side, Amazon, like its online retail offering, is a dominant player. It has a 30% market share as well. Over the years, Amazon has acquired a number of businesses, and the most recent one being the Whole Foods acquisition that was done back in June 2017. Zooming out to Amazon's industries, I will be presenting 3 industries, 2 of which Amazon is a current incumbent, whereas the other one, Amazon is a new entrant. Going through the market landscape of the first industry, infrastructure as a service or IaaS. This market is highly consolidated. As you can see, Amazon is a dominant player. big market share over there, and there is less than 10 competing companies as the composition of the market. Followed by apparel retail. Online apparel retail is the polar opposite of the IAS market. This market is heavily differentiated and fragmented. This market has 72% of the market share attributed to independent online retailers. And even the biggest retailer, which is Gap, actually occupies only 3% of the market. Amazon is a current incumbent with 2% of this market. The last market that we would want to show you is pharmacies and PBM. As my colleague has explained, PBM stands for Pharmacy Benefit Manager. The difference between pharmacy benefit managers and retail pharmacies is that pharmacy benefit managers do not actually sell prescription drugs directly. Instead, they process insurance claims for these prescription drugs. In this market, as you can see, the landscape is highly consolidated, and our proposed target for today, Rite Aid, sits comfortably in both the pharmacy and PBM markets. In the PBM market, it has a 6% market share, and in terms of the prescription drugs market, our target Rite Aid has a 3% market share, which we adjusted for the pro forma number of stores due to the divestiture deal with Walgreens Boots Alliance. Now, this market share figure was calculated using the sum of parts method and the comparable stores revenue for Rite Aid stores. Moving on to our strategic observations within these three markets, we'd like to point out that the first market that we showed, cloud infrastructure as a service, is highly consolidated, and Amazon itself is an incumbent as well as the dominant player. This will raise very specific issues in antitrust. Given the current sentiment of the administration, we would see a lot of regulatory challenges going forward. On the upside, this industry has the best margins, and also Amazon sits comfortably at 26% in terms of operating margin. Moving on to the online apparel industry. Amazon at the online apparel industry is an actual incumbent, as well as there is so little possibilities of actual consolidation in this industry. This leads to minimal to none strategic gains from M&A, as well as it actually strengthens Amazon's status quo as a third-party retail marketplace. Last one, which we actually chose for our target, which is the pharmacy PBM space. This industry is a new market for Amazon, and Amazon, in the true spirit of innovation, would be able to take synergies from integrating the complicated PBM process into something that's very familiar as a shopping experience. Now we move on to our target. Our target is Rite Aid. To most of you, our target Rite Aid is the physical brick-and-mortar pharmacy, the fourth largest pharmacy in the US adjusted to pro forma figures. Rite Aid actually has two separate business units, one Rite Aid, the retail pharmacy, and second Envision RX, the PBM, which it acquired back in 2015. Key events for Rite Aid had been the recent deal that was actually blocked by FTC with its proposed merger with Walgreens Boots Alliance, or WBA as we refer to. This deal, when it was first announced, caused a massive increase in its stock price, and as it was subsequently blocked earlier this year, it caused a downturn. So basically this extra stock price change is actually attributed solely to the deal. Apart from that, Rite Aid, as I've mentioned earlier, is an integrated retail pharmacy and PBM. And zooming out to the industry, this is a very, very important fact. The pharmacy PBM space is a very complicated and complex, especially in regulatory terms, of an environment. Pharmacy PBMs are vertical integrations within the industry. So whereas PBMs handle insurance claims of more than 250 million US lives, pharmacies actually do the physical delivery due to regulatory issues. Pharmacy PBMs, like Rite is of very high interest with a lot of the sentiments in the industry due to the reasoning that pharmacy PBMs have a very diversified and rich source of revenue. As you can see, pharmacy PBMs generate revenue from both the pharmacy side through co-pays from both insurance as well as the retail from consumer paying part of their prescription, as well as on the PBM side as they actually obtain rebates from both pharmaceutical manufacturers as well as independent pharmacies who want to list themselves on either the formulary or the list of approved pharmacies. Amazon, as a large online retailer, as well as on the B2B side, is well placed within this market to actually become a pharmacy PBM itself. In fact, Amazon has a mini or micro PBM within its company that serves its own employees. As you can observe on the lower half of the screen, you can see that the complicated process that regular US consumers have to go through in order to get their prescriptions, they actually need to submit their claims to PBMs in terms of getting the insurance copay, all the way to getting their actual drugs delivered into the pharmacies. One of the example of companies that do this is basically Rite. But what is very remarkable here is that this process is exactly identical to Amazon's very familiar retail experience. You go online, you add items to your basket, get them delivered. So this creates a huge opportunity for Amazon to actually revolutionize pharmacy PBMs. Secondly, if you look at the other half of the screen, we could show that Amazon actually has an interesting mix of Amazon Prime users. According to recent survey data, we're able to see that one age group that Amazon would be very interested in is the 35 to 49 age group that we've seen there. It has 48 million Prime users, and they, on an annual basis and an average basis, spend $1,200 on anything from consumer goods to electronics. Now, adding that survey data and overlaying it with the annual consumption spending for prescription drugs for the same age group, that means an additional around $500 on prescription drug spending, and this will be a huge opportunity for Amazon. As such, we would like to move on to why this deal is very strategic, and that is why we should do it today. Strategic rationale for this deal stems from one question that Amazon faces in the most recent of days. Amazon wants to get into the pharmacy PBM space. However, this space is very complicated, highly consolidated. What should Amazon do? Our proposed solution is the acquisition of a relatively small pharmacy PBM that has a PBM, mail order pharmacy, specialty pharmacy, as well as retail stores. This is due to the 5 synergies that we have identified, and we have ordered them in terms of the pro forma revenue increase that it will give to the combined company. First, we have Amazon.com integrated with Envision Mail and Envision Specialty to produce an integrated online retail experience as well as prescription drugs ordering system. Continued with the second one, which is the combined offline retail stores that they can do with their subsidiary Whole Foods Market as well as Rite Aid physical pharmacies, additionally putting lockers on the actual stores. The third one is on the B2B side. On the B2B side, AWS and Amazon Business could reach out and service healthcare customers in terms of their cloud computing needs, their logistic needs, and so on and so forth. On the fourth one, Amazon Prime. Amazon Prime subscribers, as we've explained earlier, are going into that age range, a very interesting age range, and it is naturally feasible for this combined company to offer healthcare benefits to Amazon Prime members. Last but not least, due to the recent divestiture deal with Walgreen Boots Alliance, Amazon can now make up for the loss in geographic presence in a number of states by using its wholesale licenses to make up for that.
Thank you, Darren. I will continue on the valuation and financing. So we used a couple of methods to evaluate the enterprise value of the company and the offering price. So the offering price is 3.58, and to arrive at that price, we used a couple of methods, as I've mentioned. So the first one was the comparable company analysis. So we used trading companies that were selected on the basis of similar operational and financial performances, and we identified 10 potential similar companies operating in both B2B and B2C segments, as our target company is actually performing as well. For the purpose of the valuation, we've used EV to EBITDA and EV to sales multiples, and for the purpose of this graph, we've used EV to EBITDA multiples, but other multiples can be found in the appendix. So as you see, just to give you an example, our EV to 2018 estimated EBITDA is actually 10.9, which is here, and it is higher than the industry median in B2C of 8.3, and it's slightly lower than the median in B2B business, but as our company has only 27% of its revenue in B2B business, its weighted average median is still higher than the market. Then we also considered the transaction comparables. To select the universe of transactions, we identified two criteria. First of all, the deal should be higher than $100 million, and it should not be older than 3 years back. And our industry median is using EV LTM EBITDA is 9.6, as you see here. And the median premium to 1 day trading price is 25%, and 42% for the 4-week trading price. Then we went on to use a DCF analysis. For this approach, we could have, as you know, our company has sold 40% of its core business to Walgreens, and to estimate revenue, we could have used two approaches, which could be sum of the parts analysis or using equity research analyst estimates for the revenue. And for our case, we could have used sum of the parts analysis, but as the legal procedure has not been finalized yet as to how the stores are going to be transferred to Walgreens, our estimates would be incorrect. So we settled on using the estimates from the equity research. And this allowed us to arrive at 7.1 billion using exit EBITDA multiple approach and 7.3 billion using the perpetuity growth approach. We've used the following assumptions in our analysis. So the stock price is 1.69 as of 22nd of November. Our analysis incorporates the adjustment that the company sold 40% of its stores, namely 1,932 stores. We've used 3% perpetuity growth as the long-term GDP growth in the United States, and we've used 11.9 exit EBITDA multiple to reflect the industry's EV EBITDA multiple. Our midpoint WACC is 7.29, but more on it a bit later, and we used end-of-year discounting convention. Our net debt, as you can see, is 4.072 billion, which is adjusted for the sale of the stores. So, as it happens, when the company would sell 40% of the stores, it would pay off the majority of for the majority of the cash that it go from the transaction, it would finance the repayment of the debt. So that's why we have the net debt of 4.072 billion. Net dilutive shares outstanding, as you see, is 1.050 billion here, which includes net dilutive options, which are in the price of 2.9 billion, which gives us the equity value per share of 3.09 using the perpetuity approach and 2.93 using the exit EBITDA approach, which is between 73 and 83% premium to the current trading price. Then we also using the WACC, we calculate WACC again using the new capital structure of the company. So our WACC is 7.28, which reflects the new capital structures I've mentioned a couple of times. We also did some sensitivity analysis on the WACC to include some potential changes in the environment. For example, if the Trump proposal to decrease the corporate tax to 90% goes ahead, then our WACC would increase by 0.6%. And now on to my colleague to talk about the football field.
Okay, thank you very much, Nikita. Now we're moving to the most important part, which is indicative overview of all valuation metrics we've used. We've chosen football field to present all of them, and we have arrived using all of the methods used at the median enterprise value of 7.7 billion, which represents a 32% premium to the current enterprise value of 5.8 billion. This 7.7 billion, using the equity bridge, converts to the implied equity value of 3.6 billion, which represents 105% premium to the current equity value as on 22nd of November, because 23rd is Thanksgiving Day and there was no trading on that day. So it implies a share price, the offer share price of $3.48 per share. So moving on to the final part of the analysis, we performed an accretion dilution analysis. As you can see, as it includes both financing option, which in our case is 100% shares, and we have done a pro forma balance sheet and a credit statistics so that we are sure that the combined company does not have too high leverage after the inclusion of 4.4 billion of the Rite debt. And having performed the pro forma EPS analysis, so as the most important factor in the proposal, the combined pro forma EPS of Amazon must be higher than the standalone EPS of Amazon before the deal. And we arrive at 0.8%, 5%, and 6.3% accretion in the year 1, 2, and 3, which is based on the assumptions of 1% deal fees and on the synergies calculated using the following method. We assumed, we actually researched that the average annual consumption spending is $500 per adult in the US. And we assume that in the year 1, it's going to be 0.5% of prime Amazon users actually using the Rite Aid to order drugs through it, followed by 2% and 3.5% in 2019, which is a very conservative estimate of synergies, and we also do not account for any of the cost synergies or other potential synergies mentioned by my colleague Darren earlier on in the presentation. However, we have still arrived at the positive accretion dilution. So, having done then the sensitivity analysis.
Thank you. We've just.
It's at the last slide.
Okay.
Sorry. So, having then done sensitivity analysis, just to double check, even given the zero and the most conservative synergies, we still arrive at the positive accretion, which means that it's going to be easy to convince targets and acquirers, shareholders, to proceed with the deal. And lastly, the contribution analysis shows that the combined entity, Rite Aid, will contribute only 1.4% to the combined enterprise value, whereas it will contribute almost 15% to the combined revenue of the company. So thank you very much. There's more information available in that appendix, and thank you very much for listening.
Thank you, that was really good, and I like the idea of that. So, on to our judges.
You described the pharmacy PBM prescription process as very similar to the online retail consumer experience. what makes you think that in a very heavily regulated industry and working with other firms like insurers, can Amazon deliver a better retail experience for the same customers?
Well, the major reasoning for the complication within the prescriptions ordering process, regulatory apart. So the regulatory issue is basically when, say for example, if Amazon wants to do this on its own, it can't do that because it needs to be a PBM to do so because it has licensing issues. However, in terms of like the technical nature or kind of the operational nature of it, this is basically the same thing in terms of basically, the way they do it is that, for example, CVS Caremark would have a website and they will just order on this CVS Caremark website and then transfer it to other independent pharmacies. So that process is basically kind of double branding. So the consumer actually sees two brands. However, this, if actually integrated into one single portal, would basically just become Amazon.
Second question. The biggest synergy that you guys give is between Amazon.com and Envision Mail. Do you guys have a number on how big of the market, or how much of Rite Aid's revenue comes from that market segment?
Right, so the thing is like this, the most important thing is to avoid double counting here. So Rite Aid has its own customer base, and this kind of attributes to their, as you look at can you bring up the pro forma analysis? Basically, this contributes to their revenue and basically income. However, the interesting thing here is that, as we put there, the integration of like an Amazon.com basically prescription ordering service would bring in more new members of the public, new members of consumers, namely the 35 to 49 age group, who would start requiring prescription drugs. And these members probably have Amazon Prime with a probability of somewhat like 35%. This market is basically 48.2 million users, and even at a minute or kind of very little 0.5% in the our assumption for synergies, that's quite a lot. That was, would you give a dollar number for it? How much was it?
It was 11.2 million till the end of the year. So that's
11 million towards the end of the year.
Okay.
Thank you.
Conservative again, given it's 34 days left to the until you publish today. Yeah.
Yeah, can we, sorry. We're like tight on time, so can we move on to the next group, please? But well done, guys.
Oh, there's a ton. Reason.
yeah.
Oh, it's touch screen. Technology, right?